Buy to open versus buy to close in options trading. In options trading, the terms buy to open and buy to close refer to specific order types that dictate how an investor enters or exits an options position. Understanding the difference is essential for successful options trading. Here's a structured guide explaining both terms. What is buy to open? Buy to open refers to purchasing an options contract to initiate a new position. Investors use this order type when they believe the underlying asset's price will move favorably and want to profit from the option's price movement. When to use buy to open. Use buy to open when entering a new options position, such as buying a call option if you expect the asset's price to rise, or buying a put option if you anticipate the price will fall. What is buy to close? Buy to close is used to close an existing short options position. Investors who have sold, written an options contract use buy to close to repurchase the contract, thereby closing their open obligation. When to use buy to close? Use buy to close when you want to exit a short options position. This could be to lock in profits, limit losses, or avoid assignment if the option is nearing expiration. Key differences between buy to open and buy to close. Buy to open initiates a new options position by purchasing contracts. Buy to close ends an existing short options position by repurchasing the sold contract. Example of buy to open. If you believe stock XYZ will rise, you might buy to open a call option. This gives you the right to buy the stock at a specified price before expiration. Example of buy to close. If you previously sold a call option on stock XYZ and now want to exit the trade, you would buy to close the call option, removing your obligation to sell the stock. Risks associated with each order. Buy to open risks. Loss of the premium paid if the option expires worthless. Buy to close risks. Buying back the option at a higher price than you sold it for, resulting in a loss. Importance of understanding. Both terms. Misusing. Buy to open and buy to close can lead to unintended trades, additional costs, or holding unwanted positions. Proper usage ensures accurate trade execution and risk management. Both buy to open and buy to close are critical components of options trading. Understanding when and how to use these orders can help investors effectively manage their options strategies, minimize risks, and optimize returns.